Silver doesn't move like this, not in a world that tells you markets are efficient, liquid, and smoothly priced by millions of rational decisions. 29. That's about a 31% collapse in a single day, and roughly a one-third peak-to-trough shock across the surrounding move. Not months, not weeks. In 48 hours, the kind of can't-happen print that turns confident commentary into silence. And here's the part most people miss. A move that violent is never just a price story. It's a plumbing story. It's a leverage story. It's a collateral story. It's about who had to sell, who could not buy, and who was quietly positioned to survive the chaos. Because while the public sees a chart that looks like a cliff, institutions see a system that has rules, thresholds, and forced actions. When those thresholds are crossed, the market doesn't ask for permission. It liquidates. They said this could never happen again after the last time. They said risk models were stronger, clearinghouses were safer, liquidity providers were deeper, and orderly markets were the default setting. But the tape doesn't care about what they said. The tape reports what the system did. And what it did was reveal something uncomfortable. Silver's paper market can swing with a violence that makes the physical market look like it's living in a different universe. If you're thinking, okay, but crashes happen, slow down. Silver is not supposed to behave like a meme stock. Silver is a global monetary metal, an industrial input, and a futures market with deep institutional participation. When it falls 30% in a day, it's not just fear, it's structure, it's margin, it's positioning. It's the hidden mechanism behind the screen. And what I'm about to lay out is not a prediction and not a pep talk. It's the pattern. The same pattern that shows up in every leverage-heavy surge, every crowded trade, every moment when official narratives say one thing while the system's stress points say another. Welcome to Channel Name. This is where we decode what matters before it becomes a headline by tracking the mechanics that move markets. The filings, the inventory data, the clearing rules, and the dislocations that show up when price is no longer a clean signal. If you've been here before, you know the drill. If you're new, consider subscribing the way you'd keep listening to that calm, experienced voice that doesn't get distracted by noise. And let me know in the comments where you're watching from. Now, let's reconstruct what happened with forensic detail, because the why only makes sense when the what is precise. Even the professionals didn't agree on what they were seeing. One high-profile strategist at a major bank framed the surge as a speculative blow-off and warned that once momentum broke, downside could be swift. Other metals analysts argued almost the opposite, that the plunge looked like a classic liquidity event, where margin and risk limits forced sales faster than physical buyers could step in. Those contradictions are not noise. They're a signal the market is shifting from a simple story to a stress test of the machinery. And when experts disagree this sharply, it usually means the old map has stopped working, and the next move will be driven less by opinions and more by constraints you can measure. That's why we follow the data relentlessly. Silver had been surging, not quietly, not gradually, but in the kind of run that attracts leverage. When price accelerates, futures volume rises, options activity thickens, and the trade becomes more about positioning than about metal. Then the air pocket opened. 29 after trading above 114 just the day before. That is a collapse large enough to trigger automatic risk limits across funds that don't even trade silver for a view, but as part of a broader allocation model. Think about that. There are strategies that buy what goes up and sell what goes down, regardless of the commodity. There are strategies that target a fixed volatility level and must reduce exposure when volatility spikes. There are strategies that run across dozens of markets and rebalance when one market blows out. Those strategies don't have emotions. They have rules. And when silver's range expands beyond historical norms, the rules force action. At the same time, anyone using leverage is suddenly facing a different reality. Futures are inherently leveraged instruments. You don't pay the full value of the contract. You post margin. And margin is not a suggestion. It is the entry ticket and the survival tax. If your account falls below a maintenance threshold, you either add capital or you sell. In a fast decline, that becomes a cascade. Now add the role of the clearinghouse. The futures exchange does not want counterparty risk. It raises margin requirements when volatility rises to protect itself in the system. Reports around this move pointed to an increase in the margin requirement on a major silver contract month, from about $22,000 per contract to around $25,000. That's a $3,000 jump per contract when price is already collapsing. If you're holding 10 contracts, that's $30,000 of additional collateral demanded. If you're holding 100, it's $300,000. And that demand arrives immediately, not politely scheduled. When a market breaks like this, it reveals fragility in its structure. And fragility doesn't disappear after one ugly day. It tends to reappear because the underlying positioning and the underlying dislocations remain. To see the hidden pattern, you have to zoom out across decades. because silver has a habit of repeating the same playbook with different costumes. Start with 1980. Silver surged into a frenzy, driven by a combination of inflation fears, speculative demand, and concentrated positioning. Then the rules changed. Margin requirements tightened. Liquidity vanished at the wrong moment. The result was a collapse that was not just a fall in price, but a forced unwinding. The lesson was simple. When a metal becomes a leveraged trade, the exchange's risk controls can become the trigger. Then jump to 2011. Silver ran up with a narrative that felt unstoppable: monetary expansion, real assets, and the idea that paper money was being diluted. The price surged, and then the air came out quickly. Again, margin increases played a role. Again, leveraged players were forced to sell. And again, the crash didn't mean the metal's story was dead. It meant the leverage was flushed out, and the market had to find its real clearing level. Now, look at 2026. In the current year, the pattern shows the same elements: a sharp run-up, crowded positioning, a volatility event, margin pressure, a liquidation cascade. And then, importantly, a snapback that suggests the decline was not purely a slow fundamental revaluation, but a mechanical event where selling pressure overwhelmed bids until the system reset. This is where it gets interesting. In each of these episodes, the first move is not the whole story. It clears leverage, it clears weak hands, it clears risk budgets. And after that clearing, the market often moves into a new regime where the next phase is driven less by optimism and more by constraints: physical availability, inventory flows, and the willingness of institutions to provide liquidity. So who are the players in this story today? It's not one villain and one hero. It's a network of institutions, each doing what their incentives demand. First, the exchange and its clearinghouse. When volatility spikes, the clearinghouse protects itself. That means raising margin, tightening collateral rules, and forcing participants to post more capital against the same exposure. This is not manipulation as a talking point. This is how the system survives. But survival for the system can look like disaster for the leveraged participant. Second, the big banks and prime brokers. They finance positions, clear trades, and manage risk across client books. When volatility explodes, they raise haircuts, reduce exposure, and demand more collateral. If you've ever watched a crowded trade unwind, you know it rarely unwinds politely. It unwinds when financing is pulled. Third, funds that trade systematically. CTAs, risk parity, volatility control strategies, and macro funds that run cross-asset books. They respond to signals. They respond to volatility. They respond to drawdown limits. When those triggers hit, they sell. And because many of them use similar risk frameworks, they can sell together, amplifying the move. Fourth, the entities that deal in physical metal and the infrastructure around it: vault operators, bullion banks, fabricators, ETF custodians, mints. They live in a world where the price is one thing, but the actual metal is another. When price collapses violently, physical demand can spike, spreads can widen, and delivery incentives can shift. This is where paper and physical begin to separate. Fifth, regulators and policymakers. The CFTC monitors markets. Central banks influence rates and liquidity conditions. The Federal Reserve affects the cost of holding non-yielding assets through policy and communication. None of them controls a single day's print in silver, but they shape the environment in which leverage builds and breaks. Now, let's talk about the dislocation, because this is the part no one is discussing with enough precision. Two sets of data points can tell opposite stories at the same time. It suggests overbought conditions, speculative excess, and a need for a reset. On the other side, the physical and inventory data can suggest that the metal is not endlessly available at any price, and that certain stockpiles are moving in ways that don't match the chaos of the paper market. 3% from the prior month. That may sound small, but in a market where flows matter, even small percentage changes represent large absolute quantities. And when price is collapsing on the screen, a decline in vaulted holdings is not the signal you'd expect if the world were suddenly swimming in unwanted silver. Then look at the exchange inventories that matter for deliverability. The market often cites big numbers, but the key is the breakdown. One snapshot shows a split like this: roughly 103 million ounces in registered inventory, which is categorized as deliverable against futures, and around 292 million ounces in eligible inventory, which is stored in the system but not designated for delivery. Eligible is not meaningless, but it's not the same as registered. It's metal that could become deliverable if the owner chooses to convert it, but choice matters when incentives shift. Here's the logic bridge. If a futures market becomes stressed and participants fear delivery constraints, the market can do something counterintuitive. It can slam the price to force liquidation and reduce open interest, reducing the number of contracts that might seek delivery. In other words, price can be used by the system as a pressure valve to shrink obligations. And that's why a collapse can coexist with evidence of physical tightness or physical drawdowns. The objectives are different. The paper market is reducing leverage. The physical market is managing metal. Now let's anchor this with numbers, because numbers keep this grounded. 29, about 31%. That move is large enough to exceed the risk limits of many strategies. It's also large enough to trigger options-related hedging flows. When options are in play, dealers hedge dynamically. If the market falls, they may need to sell futures to stay hedged, which can accelerate declines. The exact positioning varies, but the mechanism is consistent. In high volatility, hedging flows can become pro-cyclical. Second, the margin stress. The reported increase from around 22,000 to around 25,000 per contract. Think about the timing. If you hike margin into a volatility spike, you are effectively demanding more cash at the worst moment. That pushes the weakest hands out. It reduces open interest. It stabilizes the clearinghouse. But it also can create a temporary vacuum in bids because forced sellers don't negotiate. 3% and the registered versus eligible split that shows deliverable stocks are a subset of the headline number. Those facts don't prove a shortage by themselves, but they do prove that the physical market is not simply an infinite sponge that absorbs paper volatility without consequence. Now, we need to explain how this was executed, in plain language, without dumbing it down, because the mechanism is the story. Imagine a crowded theater. Everyone is fine while the exits are clear. Now imagine a false alarm triggers, and suddenly people rush the doors. The doors don't move, the crowd does. In futures markets, leverage is the crowd. Margin is the door width. When volatility rises, the exchange narrows the door by demanding more margin. At the same time, price falling makes people push harder to get out because their losses grow quickly. The result is a stampede where the first people out get a decent price, and the last people out get whatever price is left. Now add a second layer. Some of the crowd isn't even trying to leave because they're scared. They're leaving because their rules say they must leave. Their risk model sees volatility, and it forces them to reduce exposure. That's like a group of security guards also pushing people toward the exit, not because it's necessary for safety, but because that's the protocol. Then add the third layer, financing. If you can't provide it, your lender sells your ticket and walks you out. That's forced liquidation. It's not opinion, it's math. This is why silver can crash in a way that looks irrational to the casual observer. The move isn't the market deciding. The metal is suddenly worth less. The move is the system enforcing its constraints. It's the clearinghouse protecting itself. It's funds obeying rules. It's lenders managing exposure. It's options hedging, becoming mechanical. And in that environment, the chart becomes a record of forced actions, not a clean referendum on value. So what comes next after a clearing event like this? This is where we shift from the drama of the crash to the discipline of forward analysis, not prophecy, pattern. Historically, when silver experiences a violent leverage flush, three broad outcomes tend to compete. The conservative outcome is stabilization and mean reversion. After the liquidation, price consolidates, volatility cools, margin requirements eventually ease, open interest rebuilds, but with a different mix of participants. This tends to happen if physical supply remains sufficient and macro conditions are not pushing investors back into metals aggressively. The moderate outcome is a whipsaw regime. Price remains unstable, with sharp rallies and sharp drops, because the market is trying to discover where real demand sits after leverage is damaged. In this regime, the dislocation between paper and physical can widen, premiums can behave strangely, and news headlines lag the reality on the ground. You might see days of large percentage moves that would have been considered extreme in calmer years. The aggressive outcome is a renewed squeeze dynamic, not necessarily in a price straight up, but in the structure. Repeated stress events as the market tests deliverability, inventory draws, and the willingness of holders to convert eligible stocks into registered deliverable stocks. This outcome tends to appear when physical demand strengthens into a market whose paper side has become more cautious, causing the bridge between contracts and metal to feel narrower. Notice what determines which outcome dominates. It's not one chart pattern. It's the indicators that reflect the system's internal state. So what should be watched specifically if you want to understand whether this was the end or the beginning? Watch margin policy changes, not because higher margin is bad, but because margin changes reveal the clearinghouse's perception of risk. If margin stays elevated, it tells you the system expects volatility to remain a threat. If margin eases, it suggests stabilization. Watch open interest and delivery behavior. When open interest collapses, it indicates the trade was crowded and got cleared. If open interest rebuilds quickly, it can signal new participation. Delivery notices and the relationship between registered and eligible inventory can hint at whether the market's obligations are shrinking or merely shifting. Watch physical premiums and regional spreads. If the futures price collapses but physical premiums rise, that's a dislocation. It says the paper market is liquidating while real buyers are still bidding for metal. If premiums collapse too, that says demand is weak and the move is more purely risk-off. Watch the macro backdrop that influences metals, real yields, dollar strength, and liquidity conditions. Silver doesn't trade in a vacuum. But also remember that this particular crash was not explained by a slow macro change. It was too fast. It was mechanical. Macro may shape the next phase, but mechanics shape the first blow. Now let's connect this to the core thesis. The silver crash was just the beginning, not because the price must do anything dramatic, but because the crash exposed a fault line. And once a fault line is exposed, aftershocks follow. After a clearing event, the market often enters a period where narratives fight the data. One side will call it a bubble that burst, and they'll point to the chart as proof. Another side will say it was a forced liquidation, and they'll point to margin, volatility, and inventories. The truth is usually that both are partially correct. A crowded trade did unwind, but the way it unwound tells you something deeper. The system is sensitive, and sensitivity is what creates opportunity for institutions and danger for late reactions. Institutions don't need to be right on the story. They need to be right on the mechanics. They ask, where is forced selling likely? Where is liquidity thin? Where will risk managers tighten? Where will collateral be demanded? And where can they provide liquidity with an edge? That's why the divide matters. The divide is not intelligence, it's attention. Most people only see price, they see red candles and assume fundamentals changed. But the data shows something else entirely. It shows that the biggest moves often happen when rules and constraints collide with positioning. Those who understand this don't necessarily win every trade. They simply avoid being shocked by what the system is capable of. It's the system doing what it does when leverage builds too high and volatility arrives too fast. Those who don't understand it tend to react emotionally. They chase moves late, sell lows, buy highs, and interpret the market's forced actions as a personal signal. They read headlines that arrive after the move, and they treat the narrative as the cause when the mechanism was the cause. And here's the most consistent pattern of all. Institutions move first because they monitor the pipes. Retail moves last because they monitor the headlines. That gap is not just an information gap. It becomes a wealth gap over time. So let's bring this to a clear ending. Silver's crash was not just a dramatic event. It was a stress test. It revealed how quickly paper exposure can be cleared, how margin can amplify a move, and how physical data can drift in a different direction than the screen price. It pulled back the curtain on a market that many people treat like a simple commodity, but which actually behaves like a leveraged financial instrument with a physical backbone. If the next phase is calm, the lesson remains. If the next phase is volatile, the lesson becomes even more valuable. Either way, the question isn't whether silver can move violently. You've already seen that it can. The question is whether you're watching the mechanism that creates those moves before the move forces everyone to care. This is channel name, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And as the market digests what just happened, keep one thought in mind. The first crash is rarely the full story. It's the opening chapter.